Good afternoon, everyone. This is Chrissy from Solstice ATR. You can find us on the website and with the assistance of Axel Capital. On Twitter, my handle is Chrissy Farah. On Instagram, it's FARH 9052. On Discord, 9345. We have a live trading chat room, live time trading currencies, futures, commodities, equities, and options. If you like this video, hit the smash button. You can subscribe on the weekly video for free. And let's get started. Remember, for illustration use only, we're not a broker dealer. Past performance doesn't indicate future results. Use at your own risk. And the data may not be copied unless you ask for permission for it, okay? Let's first take a look at the things I want to go over. We'll flip one more page. And what I'll do, I'll maximize it so you can see it a little bit better. Is the technology sector and growth companies are ready to retake the leadership? This is two things we have to pay attention to. Inflation, make sure we adapt to the direction in the market. Don't be biased to the news. And what I want to do, make sure the outlook when we are swing trading is usually not just a month, 2 month outlook. We're looking, for a 6 month, 12 month, 18 months, 24 month out. If you are a swing trader, the daily noise makes it hard for the average consumer to trade these markets when there's a little bit of more volatility. There's very little evidence that we are heading on a spiral to doomsday, okay? But what I mean for a crash. Until the VIX picks itself and interest rates and inflation, this is when I start seeing in the global markets that there's no support by the Feds or the European zone or the Australian zone or Asia, then things will start to turn. You have to be on the defensive side, no bias to any side. Remain open mind to changes in the market. Majority of the fear gauge, such as the VIX that measures the fear in the market, or UVXY or VXX or /VX, has not shown its legs starting to peak back up above the 2025 area. It's sitting around between the $17 to $19. It depends on which instrument you are looking at. So we will take a look at it a little bit in detail. And don't listen to the media. Remember, our market can continue on an up move even if we have light volume. Usually a friend of mine, he's from Colorado, he goes by Javon D on Twitter. I do thank him. He said one time to me in the chat room, and it's stuck to my head, and we are buddies, and he said something very important. Light volume kill fuzzy. That means the lighter the volume, the more bullish it is. Sometimes we can go up on vapor. So this is very important. Don't get caught. So, and trade what's given to you in front of the charts. Here are some of the futures that I will be covering. I'll cover the dollar, gold and oil, BTC, some of the ETFs, they are right here. Apple, you can, slow down. Costco, Microsoft, Netflix, and Tesla, and WYNN. And I put WYNN there because remember, people are starting to go out due to the vaccinations, and things are, opening up, going back to restaurant, going back to football game, baseball game, soccer game, swimming team. So, these are the things we have to pay attention. I will come back to this slide at the end, and I have a couple more to show you what the outlook will be in the next 1, 2, 3, 5-year, 10-year outlook. Okay, let's first start by taking a look. I put the SPX, the Dow Jones Industrial, and the NASDAQ without the small cap. The NASDAQ before 1987, the first crash we had, the NASDAQ came into play. Then we had the technology bubble in 1999, 2000, 2001, the Twin Tower, 2008, 2009, the real estate bubble. Then we had the French in 2016, the European zone, the British exit. Then the elections in 2017, the tariff, the trade wars. And in 2020, we had the COVID-19. And eventually, all the global markets have printed money. and has helped not the really the small consumer as much as big of the corporation. So there was a glitch in the map. We fell down. These candles are quarterly candles, not a daily candle. So I'm using every 3 months, one candle. It will represent the quarter. So every 4 candles is 1 year. So this is the reason why I put the NASDAQ to show you how it spiraled up after 2010, 2013. We eventually in March cleared everything and we rallied straight up. So if I do take the NASDAQ off out of the picture and I just have the Dow Jones Industrial Average as well as the S&P, that can go back, to the 1930s range. So let's zoom down first. You can see from the 1930s all the way till, we'll take it to the 1955 area, and we'll start going right to the right of it, okay? So let's do this. As we can see, we had, here that major drop. Then we continue till 2000, till 1950s. Then we continued higher. As we can see, we had some glitches along the way in the 70s and the 80s. And when we got to the 80s, we were range bound from 1965, as you can see, all the way till 1980 area before we continued higher. And if we just take from the 1980s and on, this is the reason why I wanted to put this up here, just to show you that since, from the 1960s till the 1980s, there wasn't much except range-bound market for quite a period of time, almost from the 60s to the 70s, 70s to the 80s, 20 years, 2 decades, side market. And eventually we started rallying. Then we had that real correction in 1987. Then it took it about a year and a half to continue higher. Then we rallied from there all the way till 1999, 2000, and 2001, where the Twin Towers got hit in the tech bubble. We fell back down, and in 2008 we recovered all that bubble, as you can see. In 2008, 2009 we had the real estate bubble. We retested 100% of that move. Since then we've been rallying quite a bit higher. We had, the Eurozone, the British exit right here. You can see it in the French. Then you had, in Germany. Then we had the trade wars, and the currency wars. Then eventually we had the COVID-19 and we rallied higher. If I do take this on a chart a little differently and project what we are looking at, so I want you to be always thinking not just on the short term, because we day trade usually on the short term in my group, but on the long term we swing trade. We don't talk about much swing trading as long as we're positioning a trade. Let's say we end up buying Microsoft for a year or so, or we end up buying AMD, whatever the instrument is, we're holding it for the long term, or you're buying an electronically traded fund. In that noise in between, you just reposition your trades as long as you get in and get out of it, maybe once or twice a year, to just rebalance your portfolio, or you hedge it in options. These are the things we do. But if I look at it on a little different way and look at the projections that I have taken from historical, these are real historical numbers. As of Wednesday, Thursday, I did those calculations. You can see here what I've done. I'm going to maximize this sell. I've taken only the S&P 500. It's the same chart. But I wanted to show you the 2003, 2009, all these corrections in the S&P where we had the major drops. We had as low as 0.7 and as high as 13% drop. These are the days how long they lasted, the drops from, 15 days, 14 days, not even a 0 day, up to 363 days to recover that whole move from the drop. Then we continued higher. If I take the projection of 4,100 in the S&P 500 right now, and I project a 5% drop in the market, we can see that number is about 3380. If I take a 7% drop, it's about 3785. And if I do take a drop of 12%, we have 3556. Is the market due for correction? Doesn't have to. But I'm giving you this scenario in case the market drops further down. And if we have an average drop between 2% up to 5%, we know what the scenarios drops are from that 4,100. If I have around 5% drop, we'll get about 3,800 bucks. If we have a 3% drop, we'll get to 3,970, 80 area, smaller drop, because we are away from the 18 simple moving average. And this is the reason why I put that up for you guys. And I will do one more slide, end of the video. Let's go back now to the charts. And I will go to the S&P 500 SPX. So you can see it. If I do, instead of the quarterly, we come here to the time frame. Instead of maximum, we go 2 years. And we go, instead of quarterly, we just go to daily. And instead of 2 days, we'll just do 1 day. I'm going to just show you this from the start of the February 1920 till the March 23rd drop. We fell all the way down. We recovered into this area. Let's just zoom into here. And what I want to show you is from August till, September we dropped. Then from September through November we lifted up. We fell back down and we lifted back in November, October, November, August, September, October, November, December. Before the December rally, we consolidated here in November and eventually we broke up. Ever since then, we have rallied high. These are what I call secure highs when we break out of that W pattern. We consolidated for a while and we continued higher. As we can see between this candle and this candle, there's a slight little gap. If you see the high is 3589.81 and the low of this candle is 3594.50 and this one 3,594.39. There's a tiny little gap and I believe this area should hold in case we fall all the way down to this area. That's going to be very dramatic drop and that's more than 13% drop. But what I'm thinking, if we do ever get a correction, this second area here should hold us very naturally high. We got the 200 SMA, the 116 SMA is very critical on my chart, and that's around 3760 area. Do I believe that we can continue going higher in the market after the correction? Yes, and we had, consolidation here after the January, this was the December high. Then, this is December high, March 30, where is it? March 31st. This was the high, March 31st of 2020. December 31st, 2020. And after that, we rallied, came back down, rallied, came back down. In February, March, we consolidated. We did a little bit like a cone. If I connect these dots from here, going up, we can go a little higher. I'm just going to connect them so that way you guys can see how to look at channels and regression channels. It may be boring for some, but I want you to be aware of it. If this cannot clear this channel, go up and fall back through it, I would look for the backside of this channel and this connection. That would be a linear regression channel, and we can come back halfway to this area and the 18 simple moving average, and that's my 50 right here. This is the reason why I am showing you the SPX without any Fibonacci's other than the one that the machine grabbed. That's the support. That's the 61. My F6, F5 is 50. My F3 is 38.2 Fib. I know I went a little bit too much on that, but let's continue from here. And what I'm going to do is grab the shorter time frame for 3 months only. We're going to go from intraday. We're going to switch it to, instead of 20 days, we have a 90-day. We're going to do 4-hour charts for most of the instruments I'm going to look at today. And the reason behind it, the gray area is the overnight action, and the trading hours is the black area where you can see the gaps in the SPX in the market. And this is the reason you have a small little gap here. And, we continued higher. We have a tiny little one right here. You can see it. That's another one in that area. That's in the 39.20 area, 15 area. So these are the things I want you to pay attention to in case we retrace. So do we continue with the growth companies and technology companies other than the staples and other than the consumer products? Okay, let's go one by one. We look at the RTY. RTY, as you can see, since the annual high, we had the March, Fibonacci, we came back all the way down. We retraced part of the monthly fib extensions. We fell back down. We are kind of in a flag, but this one is in a down trending channel until the 2260 area or 70 area in the Russell to clear. Then we can get clear air coming back up. If the Russell does fall through the 2200, I'll look for the backside of the channel and eventually the retracement of the 61.8 fib. If I clear this area, I'm looking for the upside, which is my weekly high and the prior ADX DMI crossings when the RSI gets above 75. This is why the machine grabbed that line, and that's a very important line at 2,300, let's call it 10. So we round it off. Let's now take a look at the YM, which is the Dow 30. We can see that in the Dow 30, we have been, continuing on. That was the annual high. We are on a continuing upslope. We can see on the monthly, we have cleared that we reset halfway, came back up, did a cup. This is what I call a cup and handle, and eventually broke up. We consolidated for almost a week. Then on Friday, the Dow Jones Industrial Average rallied quite a bit and moved a little bit higher. And this is the annual high for the year as of April on Friday. So let's take a look at now the NQ, the NASDAQ. And this is very important, critical area. We'll go back in time. Just we'll zoom down first so we can see. This was the February drop. Then the March tried to reconsolidate. Then eventually broke out of that down channel here. You can see that we were in a symmetrical triangle. We can draw a channel down this way and a channel up. This is our monthly fib, and we continued higher. We are reaching the prior annual high up here for the year. This was the March fib extensions. You can see we got that breakout out of that move. Then we continued higher. Is this the tech sector telling us, such as Apple, Amazon, Microsoft, Netflix, Lulu, Shopify, PayPal? I'm not just naming names, I'm just throwing some at you. ISRG, are they going to start moving, or Biotech, Amgen, Guild, Veritex? Are they going to start moving and we're going to go back into growth companies, or are going to be on the defensive side? And as you can see, we had that consolidation. We fell down in the overnight, and the NASDAQ recovered quite a bit from prior. Let's take a look at now the ES, which is the S&P 500. That represents the overall Fortune 500 companies in the US. Let's take a look at it. We can see we were consolidating for a while. In February, we fell down, recovered in March. We fell back down halfway in March. Then eventually the Fibonacci in March, we cleared that cup and handle. You can see it, that's a rounded bottom. That's the kind of the shoulder, and we eventually broke up. We consolidated for 2 days last week because of the Thursday push. We had the Friday holiday and over the long weekend. Then we came back on Monday. We traded inside day. Then Tuesday was an inside. Then Wednesday we gapped up a little bit. Overnight we fell in, and we eventually broke up. And this is an annual high for the year. So what I want you to pay attention to are the fib extensions on either side of the push. We are far away from the 50 as well as, the 116 SMA. If I end up losing this consolidation here, then I will look for the 50 and the bottom of the 116 SMA. If this is going to continue and we do hold the Thursday and the Wednesday range and continue higher, pay attention to the technicals. Don't be biased to one side. That's the S&P 500. Let's take a look at GC. This is something I'm kind of concerned about, gold, because it eventually tried, every time we tested the low and the linear regression, we came up, we consolidated, we were expecting a breakout, and eventually fell down to the bottom of the channel. We consolidated, it came back up here. Everybody was thinking to go back up, fell back and consolidated for 2-3 weeks. This area is very important to me. but I'm showing you this is on the, let's go to just an annual chart so you can see what I'm talking about. See, this is the linear regression channel that we are trying to get out of. If gold does get that H pattern where it created that H, it came down, created that double bottom, and if gold can clear that on the daily, the 50 SMA, my target is eventually the 116 and the top side of the linear regression channel and the extensions. If gold cannot clear the if it falls below the 1720 area, be careful of it. And this is why the reason I showed it on the daily. Let's go back now to a shorter time frame. We'll go intraday again. We'll go 90 days, and we go 4 hours. And we'll look at it a little bit closer. Concentrate. Okay, let's get the mouse. Zoom in. And what we did here, I'm showing you the monthly fib from high to low. This was a major consolidation here. This area, the 1720, I do like gold to stay above it in the 1715 area in order to continue higher. And if I see gold one more time test the 47 and clear on Monday, even in the overnight action, I'm looking for the 1760 and continuation higher. If it tests the 1736 and cannot hold in the 50 SMA, then I would be worried about gold, okay? This is something to consider. Let's now take a look at BTC, Bitcoin. And what I want to tell you is about Bitcoin. Every time we had a gap, it has continued higher. It consolidated, pushed up, consolidated, pushed up, consolidated, pushed up. And eventually when it reached that 57, it reset around the $45,000 area, then rallied back to 61, came back down to the $50,000 area. And since March, it's been range bound, trying to get a breakout. Everybody's looking for that flag. I don't believe what people tell me and what they think and what they say, you know, laser eyes, or they talk about it's the best thing to cut bread and butter. There's always, for every move up, there's a buyer and a seller. There's a bull trader and a bear trader. Don't be biased to one side. Trade what the market gives you so you don't end up getting caught and be eaten up by the sharks or the whales or the wolves in Wall Street. What I call them is basically there's bulls and bears. They always take money, but the sheep get slaughtered. So pay attention to these things. It's in a linear regression channel. You can see the downtrend. It's trying to pop up. If Bitcoin cannot clear 60,350, be careful of it, because I would think it will come back, fill 100% of this gap and eventually the bottom of this gap before continuing higher. I'm not saying it cannot. If it does clear this channel and it clears the 60,000, I would then look for the Fibonacci extensions up to the 61.8 fib. So I'm not biased to any side. So I have to pay attention to that 60,350 or below the 50,400 on either side. So let's take a look at crude oil. Oops, /CL. What am I doing? /CL. Okay, here we go. Okay, crude oil has continued higher, and eventually in March, it has been consolidating range bound between the 61.50, let's call it, and the 58.50. Gold has to hold crude oil has to hold $58 in order to continue higher. And in order to hold 58, there has to be some catalyst to push it above the 61.30. It's being range bound. It can do whatever it wants until it breaks out of this compression. Is there pressure from, going hybrid, using electrical cars? They don't want to consume oil. There's always a need for oil for heating, transportation, and other stuff. Is the technology for electric cars and trucks there? Yes, but it's not going to resolve the problem if I'm going to go across the state or cross country from here to Florida or from here to Texas in an electric car. I have to stop somewhere every 200 to 300 miles to refill. It takes a couple of hours, then continue. It'll take you more than a week to get across the border, okay? So this is something that you have to realize. Gas cars are still there, so pay attention to oil, see what it does. So let's take a look at now. I'm going to go do the IEF, which is the 7 Treasury to 10-year short-term ETFs for the bond market. If I'm looking from the drop, since it happened here on that first gap, we continued lower, then now we are consolidating. If interest rates are going to stabilize, I believe that the bond market ETF should get back to the 115 area, $116. If interest rates start to increase, home sales will slow down because or you cannot refinance, you cannot get business loans. Second thing, inflation would be around the corner. So pay attention to the ETF or the slash ZN, which is the 10-year note. ZN. Treasury, where it printed this number for me, came back down and recovered part of it. If it clears the 200, I'm still looking for that 133 area in bond market. Let's now take a look at another ETF. And what I'd like to do in that ETF, take a look at a couple of different instruments. Or we can take a look at the Vanguard VUG. I'm trying to give you the ideas. This is Vanguard gross companies. And if I'm looking at gross companies in the technology, other than the consumer staples, I want that growth to be expanding faster, even if they represent, like in the S&P 500 or the NASDAQ, those 12, 13 companies, they represent about 40% of that S&P or the NASDAQ 100. This is why you see that growth fund continuing higher. If I'm going to go play a little bit more on the conservative staple side, I'm going to look at XLP, Spider's ETF for conservative staples. And you can see it's continuing higher, but you have to pay attention to the difference between consumer products and staples and, biotech, non-biotech. I will look at the XLF, okay, which that's the banking sector. You can see that it's starting to move. If I look at the XLV, that's the health sector, you can see it's starting to move back up. If I look at the XLK, that's the, you can start to see it's got an annual high for the year. So this is the reason why I call this keep an eye on the technology and growth companies. And this is something you can look at. We can look at the SPY, which is the Fortune 5 company. I don't talk about the ETFs because we use futures to trade it. Or you can use the SPX. We can look at the QQQ. Similar, you can see it's almost at an annual high as well. And we'll look at the IWM, which is the Russell 2000 ETF. And you can see that it's created like this is the head, the shoulder. This is the head of it. This is the shoulder. In order to not to break below that 200 area, that 220 area, which I'm concerned, or 219, in order to go back up, it needs to clear the 223, 223.80, 224 area in order to continue higher and take everybody with it up if there is sector rotations in the market. I hope this was helpful. Let's go now look at a couple of stocks before we get out of here. Let me take a look at Apple. Down in a week or so, you can see on the monthly, this was the annual high in Apple. As you can see, we created that rounded bottom here. And eventually, we didn't even create a shoulder in the last 3 days, Wednesday, Thursday, Friday. We just took it, we reset right on Friday in the consolidation of the, Thursday's range to 2/3 of the move down and came back up and clear on the weekly. That's Apple. Let's take a look at the Amazon. Maybe soon. Similar situation. You can see that it broke out of that wedge and it's continuing higher. And it actually hit the monthly fib extension. This is our monthly high and low. And you can see on the monthly, it took the 23, the 38, and the 61.8 in order to it has to get to the 78, then the 200% of that move to the upside. If it resets and comes back in the 3250 area, keep an eye on it if it's a buy zone or not, if it creates that little shoulder in this area or not. That's Amazon. Let's take a look at Google. I'll do couples so we can get to do this video a little bit more sharper and more easier for us. Just zoom down. Oops, wrong way. Okay, let's zoom in. We can see that, you remember Google, I kept saying, hey, it's going to consolidate for a couple of weeks, and eventually I'd like it to break out. Here's the breakout after that report they came out, on Monday after the holidays. That shot straight up. We reconsolidated right in the upper distribution of the 1/3 of the move from the Monday move. We came back in a little bit and we continued higher. Then on Thursday we looked up, we fell back in, but we stayed above the range. Then on Friday we looked down inside the Wednesday range and we continued higher. If this is going to get an annual high and push continue higher, keep an eye and open mind to what the market can offer you. Don't be biased, because the 38.2% fib on the annual chart, this is your fib extensions to the upside on Google annual high fib extension, okay? And this will actually match between the weekly fib, the 23, the 38, and the 61.8 fib in Google. Let's take a look at NFLX. Netflix is, you can see it created that round. This is trying to clear the monthly fib. If it can clear the monthly fib, we'll look for the upside. If it cannot hold the 18 SMA, we'll look for the 50 Fibonacci weekly fib that will act as support in order to continue higher. That's Netflix. Let's take a look at Tesla. Tesla, I don't like it. I think Tesla is having a problem on the 200 simple moving average on the daily. I'm not biased to being bearish on it, but I think if it does lose the 50 SMA and the 116, it cannot hold it. I'm looking for the backside of the retracement of the 100% back move of this wedge that it broke out of, consolidated is in a wedge. Unless the momentum comes in and something comes good about Tesla, I think Tesla is heading back to this area first before it can continue higher. I'm not being bearish, I'm just giving you a fact, because Tesla, you cannot short the shares, you have to do them on options. Or if you own the position, protect your capital, because I don't like the chart on Tesla. Let's take a look at WYNN. And when you can see, because of everybody, last week, long weekend, the casinos in Las Vegas and other stuff were a little bit packed. They retraced a little bit and fell back down. We got to keep an eye on that 200 SMA if it's going to hold in order to continue higher. Let's go back to ES. And what I want to do is make sure that you understand the monkey bar volume profile. And I will show you last but not least what I was talking about. Let's just zoom down here. Oops. Okay, I have the weekly range for the week. Most of the consolidation happened in this area. That's where most of the POC was. And officially we ran away. So if the market is going to come back to retest the 18 SMA and hold, we can continue higher. I'm not biased to being bearish. Let's see what the market gives us on Monday, and the overnight action in the European Asian markets on Sunday afternoon when the markets open in the US market. If I want to look at the monkey bars, I go to style, or you can use volume profile. We go to the monkey bar here. We can see that this is a 15-minute daily 5 days, and you can see that my fib, what is that? That's 5 days. Okay, we'll just go a little bit more time frame. Instead of 5 days, we'll do 10, and we'll do 30, so we can see how far we can go back. You can see that from the Thursday action, this is my low for the week, and this is my high, and you can see my POCs here were more concentrated. This is the value area high, value area low. That's the POC, and that's the time spent. Eventually, we consolidated for 2 days. We broke away, went higher, and we have higher. This is a virgin control point, and this is a virgin control point in the POC. If we do come back and revisit this area, look for opportunity for a buyback to continue higher unless the trend does change in the market. Let's go back to the simple charts. We are in that linear regression channel continuing higher. What we can do, we can grab a line from here. We connect those two dots. We connect this area here with this one here. That's a linear regression channel. And I connect this one here with this area here, with this high here. You can see we are in a linear regression channel. Even if we come back halfway, we should be still bullish, and that's your 50 SMA on the charts on the 4-hour. Least but not last, like I promised, I wanted to go over this one. We're going to zoom up and go to the right. And this is the reason why I look at the historical rate of return, and I did the compounding rates from 2003 till 2020, how long the downside risk was and the upside in the market. Remember, in the prior one, I showed you just the negativity of the market, and the average 1 month, dump, we can lose, 5%, 3%, 2%. But in order to continue, and even in 3 months, 12%, dump, in order to continue on a 2-year outlook, 18-month outlook, 3-year outlook, 4 and 5. But since the 2019, I cannot calculate for more than 2 years. I can look for the last 3. I can't show you the numbers. And here in 2020, I cannot show you more than a year outlook, because this is the maximum I can go. So if I'm looking at the 5-year range, I know 52 is the lowest and the highest is 107. If I take those numbers and I average them out, our average rate of return in 5 years is about 79%. Even if I go back to a 1 year, our average rate of return is between 17%. And even if I go down to a 6-month, it's about 11%. If I go down to 3 months, it's about 5%. On the short term, it can be 2%, it can be minus 5%. So remember, we're going to trade what we see, not what we think. I hope this was helpful. Once again, you can check us out on Twitter, on Discord, on YouTube, and remember to subscribe and hit the like button and share this video with your friends. Over and out, and take care.